Good morning, good afternoon, good evening. I guess prior to the conversation, we were doing a little Japanese. So, Ohayo gozaimasu, konnichiwa, konbawa. My name is Doug Brunke. I'm the founder and CEO of Global Chamber. We have a really important conversation today. And just to preface it, Carol Schleif, who I spoke with a few weeks ago about this presentation and getting us all up to speed on what the economic forecast is, said she had one big worry, and she'll probably cover it in her presentation. And if she doesn't, I'll insert it in at the end, and you'll see. You may be able to surmise what her worry is as she begins to go through the presentation. You have reached Global Chamber. We are the only chamber in the world that has hundreds of locations that proactively connects members to clients and other resources to be successful. We spent 2025 working very hard from May 1st, implementing a new system that allows us to be able to know our members better, to be able to have members tell Globy, our AI tool, who they want to meet and what events they want to be part of. It's still not working 100% perfectly, but it is going to be working a lot better as we continue to go into 2026. And to see some of the early positive results is very exciting. So if you're a member and you haven't told Globy all of that information, there is a form you should fill out. It's been very reassuring that so many members have filled that in because 2026 is going to be pretty good. It's going to have a lot of growth, and global business is just so important to be part of. And you'll see a lot of the reasons why as you listen to Carol. I'd like to introduce Kevin Brown. He's the managing director of commercial banking at BMO, located in Chicago, Illinois. He's part of the Global Chamber Chicago Advisory Board. He's a seasoned commercial banker who brings 30 years of experience to the BMO commercial team. As we've learned in Chicago, he's an extraordinarily intelligent, experienced, creative, and innovative banker. He's been great to work with for the chapter there. He not only knows everyone, but he's dedicated to support member companies and any company that has banking needs and wants to be successful. And Kevin, it's just been a real pleasure to work with you these past years. Thank you for your support and collaboration. You would like to introduce Carol. Is there anything else you'd like to share?
No, thanks, Doug, and thanks for the very kind introduction. I just wanted to, everybody on the line, as Doug mentioned, good afternoon, good morning, or good evening, depending on where everyone is around the globe. Just on behalf of BMO and our entire team here, we just wanted to thank everyone for giving us the opportunity to be a part of today's program. So, being a full service bank that's, committed to helping our clients boldly grow the good in business and in life, one of the things that we try to do, that we really strive to do on a regular basis, is provide our clients, whether they be individuals or business owners, with meaningful and timely and relevant thought leadership content, right, to help them kind of manage their businesses and grow their businesses and achieve their financial goals. So, in that spirit, I'm happy to introduce my colleague and our guest speaker for today, as Doug mentioned, Carol Schleif. Just to give you some of Carol's background real quickly, and then I'll turn it over to her. But Carol is the Chief Market Strategist for BMO Private Wealth, which is the North American wealth management business of BMO Financial Group. In her role, Carol leads several key initiatives aimed at amplifying BMO Private Wealth's research and investment expertise, including authoring the firm's weekly strategy perspectives. She has decades in the industry, although she doesn't look like it. I think, like me, she was in the kindergarten intern program at one time. But with decades in the industry as a strategist, thought leader, and portfolio manager, she's a sought-after speaker, writer, and media commentator. She's also a member of several key asset allocation, strategy, and governance working groups across the bank, as well as leading the Senior Investment Advisory Council. Last but not least, Carol's also an active member and contributor to BMO's Women and Wealth Group. So with that, and without further ado, Carol, thanks for joining us today, and turn it over to you.
Thanks so much for having me, everyone, and thanks for the privilege of getting to talk to you about markets. It's my favorite topic, as anyone around me will tell you, and I bore my family all the time with deep diving this stuff. And oh my heavens, there's no end of stuff to talk about, not only last year into this year, but it feels like we've had a full year or two in the first week and a half or so of what's coming up here. So if we could pull up the presentation, that would be great, because I'm doing a number of these presentations. In fact, I'm doing one later this week for a group of I'm based in Minneapolis, and I'm doing one for a group of local senior executives here. And this will be the 6th year running, I think they have me coming to do it. And one of the things that I always delight in is I start the process of putting together a new Outlook deck by pulling up what I said was going to happen last year and making that typically the first slide. And one of the most interesting things we're trying to grapple with right now is paradigms and paradoxes. We're trying to figure out, of all of the moving parts that have happened in the last year or so, what changes the arc, what reinforces or does away with old paradigms, what's just unusual things. And so we'll dig into some of that stuff today. So if you could go to the next slide, please. I'll do a little bit of level set. Can we advance? There we go. Well, I'll do a little bit of level set, just bringing through and having us take a step back and a breath about what was 25. We'll look at a few of the surprises that were there, and yet how the markets performed, which is really a necessary place to start in terms of looking at 2026 and what comes on again. And I'll spoil the info for you right here, because one of the things, my biggest concern is that as I do go through that process and I look at what last year was and how resilient markets were and where we're teeing up for this year, and the fact that we've cleared a lot of waves, we come to a pretty constructive outlook for 2026. But we're in the camp with everybody else in that having a constructive outlook. And it's been a long time, probably since 22 or 23, since you've had anyone out there, notwithstanding all of what went on around last April and so-called Liberation Day in the United States, and that caused some people to pull back and put recessionary out there. But it's been a long time since we've had everybody in the bullish consensus, if you will, for the coming year. And quite frankly, I think if we're wrong, it could be because we're too conservative about expectations for the coming year, because there's a lot that we'll get into here that has the economy, not just in the US, but globally, teed up to have a pretty constructive year in the year ahead. So we'll do some macro observations, and we'll talk about what's being over and under emphasized in the markets. And then we'll try to talk about implications. And I put portfolios and psyches, but more for businesses, portfolios, how we approach things. And one thing to keep in mind is I have been in the business for a very long period of time, and that taints or colors my perspective. My entire time in the business has been spent on the dealing with individual businesses. I was an analyst. I ran research departments. I've done research and strategy on the side. I've also managed portfolios for multi-generational families, run teams that manage those portfolios. So my perspective is all around business, and on both sides of it, both the companies themselves as a strategist and a research professional, but also the businesses and the people and the real life and the front line that creates those businesses. So we'll talk about some of that, and I will leave time for Q&A. So if we can advance to the next slide. Another thing is about this deck, I tend to be a very visual person. So there's a lot of, there's some charts in here, but there's more magazine covers and cartoons, because that's the way that I really resonate with that. And I think a lot of us do, in terms of, you can pick up a magazine cover and pretty quickly tell where the psyche and the main thematics are going, rightly or wrongly. And through the decades, a lot of times magazine covers have been antithetical in terms of, by the time they hit the cover, they're wrong about what they're calling. And so it's interesting, because the last couple of years when I've done this presentation, I've been able to pull magazine covers like this that talk about America's pumped up economy and how high can the markets go. It's really important to remember that we started 2025 a stepping off point, very strongly and very optimistically, if you will, in markets. Came up after the election in late 24, and there was a lot of optimism. Wall Street had staffed up with M&A and IPO. Animal spirits were roaring again. People were feeling like this was going to be a carbon copy of what Trump 1.0 was, which is you had a lot of very business friendly things happen early in that term. And then we had some tariff issues at the back end of that term that got swept up into COVID, and a lot of it got forgotten. The trade war initially with China started in 2018, not in 2024 or 2025. So it's important to remember that piece of it, that the stepping off point was very strong. Flip the page, please. So we did have that strong economic, we had economic or GDP growth running around 3%. If you can advance the slide, please. We had very strong stepping off point, not just psychologically based on 2 double-digit up years coming into the year, but we also had a lot of that optimism that was floating around in the business community, because the Trump administration came in with a lot of promises for deregulation and tax reform and lots of different things. But what I like to say here is one of the things we pointed out through the years, we pretty quickly came to the conclusion that it was, instead of having a carbon copy, it was going to be a mirror image, meaning we were going to have to take the veggies first. And there were a lot of business not so friendly things that happened right away. And the thing that took a lot of people by surprise is it seemed like everything everywhere all at once. And one of the things, I started writing a weekly strategy piece. We launched it a year ago, first week of January of 2025, with the very first issue being called Buckle Up, because we suspected there would be some volatility in the year, but even we didn't expect the level of volatility and the level of things thrown at the wall. And one of my earliest issues last year, I talked about a lot of policy spaghetti being flung at the wall, and figuring out what sticks, what stains, and what slides off is what markets were grappling with. And quite frankly, that's the way we spent a lot of the year. So you saw that post-election exuberance pretty quickly wobble. We had Doge, we had political and geopolitical. You had all of the angst in the media talking about this head of this agency and that head of that agency, and could they get approved and could they get through? And then all of a sudden, and you had President Trump running to the Supreme Court to get emergency agreements for all of the things he wanted to do. And it left markets reeling as people were trying to figure out what to do. And then, of course, we also, in the middle of all of that, had our DeepSeek moment. And the funny thing is like a lot of this stuff happened over a weekend. So it was always a Monday morning crisis going on in the markets. You had a lot of that stuff going on. So I saw a question pop in, and I will get to the bubble question. It's buried in here. We'll get to that too. So we had trade and tariff policy then come in, and that obviously threw people for a loop, especially by the time we got to Liberation Day. And it felt like almost, we called it the Oprah approach, because it was almost like you get a tariff and you get a tariff and you get a tariff. And it was pretty unsettling for markets and definitely unsettling for businesses. But go ahead and advance the page. So by the time we got to the 100th day of the Trump administration, all of that exuberance coming in, if you can advance the page, please. These are some of my favorite covers from last year. These were the 100-day covers, where actually, if you count the hash marks behind Lady Liberty, it's 100 hash marks. And The Economist with only 1,361 days to go. It was pretty amusing. But that said, flip the page, please. It's really important to remember, I listed out, I was doing a presentation mid-year last year, and where we got to after all of that first round of things is that there was this push and pull in the economy going on. And I actually used this particular cartoon with a group of manufacturing executives last February, and they really keyed in on this cartoon and said, this is exactly what's going on, because you've got consumers out there were so understandably flummoxed, if you will, by all of this, that some of the spending started to soften as people were trying to figure out how to deal with potential tariffs or threatened tariffs that got pushed back then. And businesses were trying to figure out how do they deal with it. And they're like, we're not going to hire until consumers start to spend. And consumers didn't want to spend until they felt more confident about hiring. So it was that back and forth that went on. But it's really important to remember we're not going to go over all of these because we know how much there was to deal with last year. Flip the page, please. But what ended up happening is, in that spirit of veggies first, we ended up with a lot of that stuff early on. And then in the back half of the year, when some of that stuff was settled, you had the administration pushing really hard to try to get the message out that, okay, now we can really focus on the business friendly aspects of things. The one big beautiful bill got passed, and there's some very business friendly aspects to that bill that were put in there in terms of immediate expensing of some R&D expenses, a lot of things going on there. You had deregulation that we have definitely seen come through, and enhanced permitting, lessen capital requirements. There was a big focus on loosening the corset on the banking system that had been strangled, if you will, in the wake of the 08-09 crisis. And you started to see by the end of the year, you had some animal spirits reviving. There were 3 or 4 Wall Street firms that did over $1 trillion a piece in M&A last year. We saw revival of the IPO market come back. We saw the Trump administration adopt a number of different industrial policy experiments, and lots of new rules put out there, giving the rules of the road for things like stablecoin and AI and crypto, and the government basically picking some industries it wants to own, it wants put back into the United States. Sorry, I have my son's cat is in here and he's creating havoc in the background, so I'm going to have to step out and open the door. But lots of things started to go right that really helped support markets. And we ended up by the end of the year with this everything rally where you had a lot of different things going on that were very supportive of markets. So flip the page, please. And these next few we'll go through. And this deck has been approved for anyone who wants the deck. It's there. And I'm trying to see. You know what? I'll have to make sure, because for some reason in this version, what I'm seeing, it doesn't show up what the various aspects are. It's missing the deck itself has this in it, and so I'll just describe it. The lower right-hand quadrant is the one that you're looking at, and the key thing is those 3 right-hand charts are international developed, small cap, and emerging markets, which are each up over 30%. U.S. markets ended up over 17%. Flip the page, please. I don't know why these are not converting in here, because I can't see them on here, but there's titles on all of these. And the key thing is here too, by the end of the 4th quarter, this top clip, that top performing sector, which will surprise many people, was healthcare, not communication services or technology. Communication services and infotech were further down. In fact, infotech is one of the smallest upticks in the 4th quarter. So we've seen an important broadening in market expectations. So flip the page, please. I don't know how this is converting or why it's not pulling stuff in here. So apologies for that. I will have to double check this before the next time I give it. But these are world equity indexes over the last 3 years. And so you can see that the global markets in particular have performed very well. The red line in here happens to be Canada. The dark blue line is the US. Europe is the lower one, is the more greenish line in there. And emerging markets are lower down too. But you can definitely see that downtick that is in there is the Liberation Day and the reset that we had. So flip the page, please. So the bottom line on what really mattered is resilience, as opposed to, hang on a second, excuse me, out. Troublemaker out. The policies. My cleaning lady is here today too, so that's one of the reasons why he was locked in here for a period. So we've got, sorry, the resilience of corporations, investors, and consumers is the thing that kept coming through, because a lot of the media would have you believe that you needed clarity before we could get things turned around. And it's really important to remember, because those of you who work with businesses, own businesses, run businesses, business needs some amount of clarity, but business can't stop. You've got shareholders, you've got boards, you've got customers, you've got clients, you've got employees. You've got to keep moving. And so you've got to figure out how to deal. And it's also really important to remember that businesses globally, but particularly in the US and Canada, those businesses have really developed good muscle memory in terms of all the challenges they've dealt with, not the least of which trade wars started in 2018. You had all kinds of supply chain issues through there, where in the US, for example, we had the East Coast ports shut down for a long time. We had West Coast ports shut down for a long time. I personally was managing money for clients that had to, like, they were not only subjected to tariffs for the kinds of raw materials they were bringing in, but they couldn't take West Coast orders because the West Coast ports were shut down. And you remember when you had ships lined up there, you had pandemic that forced people to rethink their supply chains. And so businesses got very, very, very skilled at figuring out how to dodge and weave and how to survive in this. And so you've got the media spinning a tale. And part of the reason we're calling it paradoxes and paradigm shift, is it just something that the media keeps saying that's not true? Or is it the fact that a lot of what's going on with the Trump administration, particularly in things like most recently, which we'll talk about, the Western hemispheric shift, the geopolitical, and one of our core themes that we've put is a framework around our capital market assumptions in terms of how we're thinking about markets for the next 10 years, is the impact of that global pivot. And markets in general tend to discount geopolitical turmoil. You saw, part of what got dealt with last year is we dealt with bombing Iran, we dealt with war in the Middle East, we dealt with Russia and Ukraine. There's all these things that markets tend to look through and ignore. But the global nature of the pivot was very impactful, and it's one of the things. I mean, it arguably changed election outcomes in Canada, in the UK, elsewhere. And so the remaking of all of that has some implications for investments, intermediate and longer term. And it means it's just a really exciting period to be looking at a lot of it. So next page, please. Hopefully this cartoon translated. Yeah. So actually, the interesting thing is, when I was looking at this yesterday, this cartoon is actually 25 years old. It was from the early 2000s. But the interesting thing is, you've got both the bull and the bear in the front of the roller coaster ride, hauling all of us investors along behind, trying to figure out, both of them having a good time figuring out what does 2026 look like. So next page, please. So I already touched on this. Part of it is there's three big macro themes that are all interrelated, and a lot of sub themes factor into those, but we're really leaning into them as we look through into 2026 and beyond. One of them is the global pivot. Another one is Industrial Revolution 4.0, because it's bigger than just AI, where a lot of the mind share last year globally was related to data center spend, energy, and support of that data center spend, but what could happen there. But it's bigger and broader than that in terms of implications, and you're starting to see and hear some of that already that's coming through. So Industrial Revolution 4.0. And then our third big theme, and this one weaves through everything else, is the evolution of the capital markets. We've got a lot of stuff going on in the capital markets that are pulling things through and changing the nature of risk in each of our ability to offload risk or take risk in different places. Everything from the prediction markets to exchange traded funds, or ETFs, which in the US, there are more ETFs now than there are actual stocks, because you can take every individual stock and put multiple actively managed or leveraged ETFs on that single stock. So you can have NVIDIA and you can have an ETF that leverages to the upside and leverages it to the downside. So I, as an investor, have a lot of different ways to participate in the markets. We've got, I touched on this before, those rules and regulations around cryptocurrency on the way, but they did solidify some rules around stablecoin, which was one of the things that I ended up writing up last fall and deep diving some of that, thinking through the implications for U.S. regulations and stablecoin and what does it mean for fixed income markets and things like that. So there's a lot of moving parts there to keep track of. Flip the page, please. And it's interesting because we went from AI a year ago where we were trying to figure out is it good or bad, is it good or is it bad, to this year, Time putting it on the cover of the magazine as its person of the year or people of the year, if you look at all the people that are constructing that. Flip the page, please. And another one of the things, now we've gone from the last couple of years of having how high can markets go and can they continue to, there are a lot of concerns around bubble and a lot of concerns around will the AI topple the economy if that's going on. And so it's really important to remember. I mean, I know there's a lot of fears about bubble and a lot of them knee jerk because people are like, well, prices are up. The third year in a row that we've had double-digit increases. But people forget that the valuations have moved up somewhat. Actually, valuations are flat and tech valuations were lower at the end of the year than they were at the start of the year. Because when you're valuing stocks, one of the primary ways you do it is the price to earnings, and earnings moved up dramatically as well. And we saw earnings broaden out in the US, for example, by the end of last year, or by the end of the third quarter, we had the top line revenue growth in aggregate on the biggest companies, the S&P 500. Top line growth was 8%. Bottom line growth was over 13%. There were 4 or 5 industries that generated double-digit revenue growth. And so the valuations aren't as inflated as people would think. And there's an argument to be made that the composition of the S&P is substantially different now than it was 20 or 30 years ago, which 20 or 30 years from now, if President Trump has his way and we are reindustrialized again, there'll be an argument that valuations should be lower out there. But right now, you've got technology names driving the bulk of this. The bulk of the AI spending was done by companies with almost zero leverage because Silicon Valley CFOs have prided themselves in under-levered balance sheets. So the fact that they're putting some debt on the balance sheets to underwrite AI is tolerable, if you will. But the vast majority of the spending they're doing is coming out of cash flow. They're growing revenues from businesses and legit businesses, which makes this very different sort of run up than we had from 95 to 2000, because the kinds of companies that drove that market, which is the one this one is most commonly referenced to, where we had sock puppet companies. We had a lot of story stocks, they were called. They had no revenues, no earnings, and Wall Street was changing how it was valuing those companies to value them based on clicks and eyeballs and all sorts of things there. And any company, any old line company that put .com in its name got instant valuation increases back then, but it was based on, there was a parallel thing going on where you did have internet or you had capacity build out, but it was being done by different companies and it was being financed primarily by leverage. So you had a very different scenario than you've got going on now. And it's also impactful to remember that when the NASDAQ blew up in 2000, it peaked at 5,000 and within 2 or 3 years was under 1,000. And most of the companies in that index went bankrupt or belly up and didn't exist anymore. So the NASDAQ we have today and the kinds of companies that are in there, the valuations that are in there are all very different composition sorts of companies than you had back then because they've been created in that last 20 or 25 years. So flip the page, please. Hopefully this chart came through. Not very well, but if you across the deck, I have no idea why this is not showing up in here. But anyway, the little red arrow there, what this is this is 2, 4, 6, 8 different periods of bull market growth, all indexed to the same start period. And it shows that dark blue short line is the first short one. It shows where we are relative to other big bull runs in markets. And I've got some other charts in here in this deck that do show that the bulk of the time, something like 75 or 80% of the time, markets do go up. And the average, the bull market duration, the average duration since 1970, I believe, is about 6 years, with the average total return being about 315%. Bear markets in retrospect or in opposition, the average duration is about a year, and the average total price return is a negative 35%. And granted, bear markets are no fun to sit through. I have sat through more than my share. But yeah, here we go. So the equity valuations are higher, but not quite at historic levels. This shows you just the basic PE levels. Flip the page, please. You can go, yeah, there we go. So the Magnificent Seven is on the top, where it shows the blue line is the Magnificent Seven, and the yellow line is the S&P 500, basically without the Mag 7 in there. The bottom line shows the PE on forward earnings. So this gets at, again, excuse me, the fact that valuations have moved up, but they're still pretty consistent, and they're nowhere near as parabolic as one would think. So flip the page, please. I've got, just seeing as how we can't see them in here, I've got valuations versus profitability. Flip the page again, please. Since the numbers aren't coming through in here and it's tougher to describe. You can go ahead and flip the page. So the bar on the right-hand side shows that expectations, the 2025 should come in around 14%. Expectations for 2020, which is the middle bar, expectations for 26 are for 13.5 or 14%. And these are expected growth. I think that it's the Bloomberg aggregate expected growth on the S&P. So for another good, solid double-digit up year, my argument would be there's been enough attention to margins and what's going on in there that if anything, you could see even stronger growth and movement in that 13%, because the one thing we did see is some pretty big reset in numbers post Liberation Day last year, and the last couple quarters have pretty handily beaten that. We'll know a lot more on that front within the next 3 or 4 weeks, because this week started the U.S. started the big banks reporting, and we'll get a lot of information in the next few weeks on that. I'm actually going to have you flip the next page. There's some valuations by segment. Well, seeing as how those titles don't show up, flip the next page, please. Wow. This is just showing the key thing to keep in mind here anyway is the blue bar charts. And this is just year by year GDP growth. And the boxes in here just have some events and some average returns in here. But it's important to look at this. And it goes back to the very leftmost one is 1961. So this is actually, excuse me, quite a few decades of market or of economic upturn. And this is the justification, if you will, for why markets tend to go up and to the right, because the economy has been, particularly since the 70s and 80s, since we came out of that stagflation of the 70s, had Volcker come in and really reset the tone, if you will, for inflation and inflation management, and the Fed's position on doing that. We had it's economies tend to grow, and then flip the page, which is why the long-term trend on markets tends to be up and to the right as well. So, and this one actually, if you look at the deck, this whole bottom section on the right is a list almost of year by year of the key events that are here. And this is illustrative of the fact that markets tend to power their way through lots of different economic concerns. So flip the page, please. So hopefully we can come to some, here we go. So what investors will be watching this year, the key things they'll be watching are AI, because everybody's still hyper focused. And given earnings season, there'll be a lot of focus on is the data center spending continues. And it's frustrating for me, but I do a lot of media and I get asked to do talking points the day before I present to media. And I keep trying to get the attention focused off of it just being an AI trend, because it's really important to remember NVIDIA is not just developing AI chips, and the next round of AI chips aren't even going to need as much cooling, if you will, because they'll be able to be cooled at room temperature, which will dissuade some of those. But they're also spending big on quantum processing chips, QPUs, and there's a lot of things going on. There's a lot of commentary coming out of, there's a big healthcare conference going on this week, and there's a lot of commentary coming out of, I think it's Lilly and NVIDIA and a big joint venture that they're doing in terms of drug discovery. The first FDA approved, or there's a drug that is the first AI generated drug up in front of for FDA approval in the next few months as well. And the discovery period on that was cut substantially down. And so you'll start seeing and hearing more technology use cases, if you will. And one of the things that got buried in everything last year, Amazon passed 1 million robots in its warehouses, and we're completely rebuilding and retooling, if you will, not just the US, but the global economy, because we're rebuilding it technologically. We're rebuilding it from a partnership standpoint, a supply chain standpoint. And you think about it, if you're a manufacturer in Canada and you're trying to figure out, do I bring in, or let's use the US, and I'm trying to figure out, do I bring it in from China? Do I bring it in from someplace else? Does it have to go through the Red Sea, or does it, because of the hostilities there, it has to go around it and it has to come through different ports and in someplace else? I want to hire a logistics company that is using AI to deploy and figure all of out the logistics and what's going on here. One of the advantages I have to being based in Minneapolis is we have a lot of publicly held companies. We punch way above our weight in terms of the publicly held companies that are based here, and they're in a big, broad variety of industries. So we get a lot of good feed here that doesn't necessarily come through the media from New York or California, but we get a lot of good feed on what's going on. And one of the biggest logistics managers here, and they've been making active use of AI, and it's fun to hear the anecdotal evidence and how they're using it. So there's a lot of optimism going on around that. But that said, market focus, investor focus short term tends to be around that AI. So if people don't like what they hear out of NVIDIA or Google or Microsoft's earnings in the next couple of weeks, you could see market pullback, especially because people are fearing that bubble. They're psychologically primed to have hair trigger fingers, if you will. But we've actually seen markets be incredibly resilient. I would have been the first to swear that based on the Sunday night video from Chair Powell, that you would have seen a major market pullback yesterday. And instead, markets wobbled a little bit in the futures market, wobbled a little bit at the forefront, and then listened to what was going on and were very discerning. And between that discernment from a variety of different asset class markets and the discernment you see going on in specific industries, where last quarter, when the 5 of the Mag 7 all reported in the same week, and a couple of the stocks were up and a couple were down, that discernment inside a select industry, you saw the same thing. Costco and Walmart and Target reported on the same day. Costco and one of the others reported on the same day, and stock prices are treated differently. That's not indicative of a bubble kind of market. That's a very nervous, very discerning sort of market environment out there, and very healthy functioning markets. Alt-fi is what I tend to call alternative finance, which is the different markets. You've got a big play in the US going on right now in prediction markets, which really allow for some things to level off there too. We've got a lot going on in private credit that we're keeping an eye on, because what historically has drugged down the economy that's needed unwinding, and thus markets as well, has been when some set of incentives goes off kilter and leverage gets applied and the incentives get wrong. So if you think about it as it related to the great financial crisis, it related to the fact that when mortgages stopped being underwritten by a particular bank and held or on that bank's balance sheet or sold, when credit stopped staying inside the bank and underwriters got incented to just craft the loans and sell them someplace else so someone else could package them, and no one could understand where the risk was, that's what creates incentive for things to get over levered, people to get over their skis, and things to blow up, if you will. And so that's one of the things that is a legit concern in terms of watching AI financing, watching some of the big banks as they try to get to go into other markets. Do they peel off some of their riskiest credit? You've seen some of that stuff start to happen where they're peeling off credit, packaging it up, and selling it off. So that is one of the things. We're nowhere near where it's a bulk of the markets yet, but that's the sort of thing that we watch in terms of what's going on. There was a lot of angst last year over the dollar. It came into the year, we had a guest from inside BMO write a dissing the dollar piece for us last year, last fall. And the argument being the dollar came into 2025 overvalued relative to a lot of the other global currencies and needed to come back some. It didn't play the dollar, crypto, gold, a lot of assets didn't play. U.S. Treasuries did not play what they needed to. Did not play the stability, the portfolio stabilizer that they should have in April. But by the end of the year, they really did. Most of them, the dollar less so, but definitely gold and cryptocurrency less so as well. But because cryptocurrency is a whole different, and I hesitate to use the word asset class, it's in its infancy or adolescence, if you will. People are still trying to figure out what position it forms in a portfolio. So setting that aside, there were a lot of treasuries have been well performing and played the defensive diversifier position they needed to. Investors will be watching Fed inflation policy and independence. And I had this on here a week ago, and it definitely is true after this weekend. They'll be watching markets and deals and IPOs and the spirits roaring. And they'll also be watching trade and tariffs. But honestly, I think a lot of investors have tried for a very long time to move beyond that trade and tariff policy issue, and they really want to get on to the next issue. So flip the page, please, because this is what those things will stay in the headlines. And there's a lot that's been in the headlines. There's also a lot that hasn't necessarily been focused on as much as we need to. And I'm going to have to try to zip through the end of this because I want to make sure I leave a few minutes to answer some of the Q&A. One of the things we should be watching is consumers. Are they employed? Are they spending? I'm actually writing up employment markets this week for my weekly piece, because I do think one of the watchwords we're going to have this year is jobless growth. And I think it's going to end up being okay, but we have to get people retrained to thinking that the U.S. economy doesn't have to generate a couple $100,000 or a couple 100,000 jobs a month in order to be healthy, because we've shut down the borders. We've got an aging populace. We've got productivity coming through much stronger than people thought, because you're finally starting to get some leverage from not only artificial intelligence, but robots in manufacturing, and from driverless forklifts, if you will, from autonomous forklifts and things like that are going on that make production cheaper. And to the extent that you roll out more automated manufacturing processes, then the argument about where it's manufactured matters less because you're not looking for cheap labor sources to do that. But it leaves a lot of conundrums for the globe, intermediate and longer term, in terms of what steps are we going to take, what steps are companies going to take to retrain workers, reskill workers, and get people to lean into the new environment, if you will. Those geopolitical pivots and implications, global market rebalancing, that stuff continues. And I put whales versus krill in here because I still think, for better or worse, particularly in the US, large companies are dominating. The current administration is allowing a lot bigger M&A. It's tougher for the small companies to lobby for tariff exemptions and all the other things, all the other advantages. When Trump calls the energy execs, he's not calling the wildcatters the second and third tier. He's calling those big majors into his office, and that sort of stuff is very tough. And I think the other thing, what we should be watching is keeping an eye not just on the AI, but also on those disruptive technologies. Because from what I understand, I know there's a lot of investment going in quantum, and there's some schools of thought that if and when quantum achieves commercial viability, it has the ability to break the entire code of what's kept crypto. So we may do away with an entire industry because we bring another one in and we bring another processing in. And the way quantum works is it does need AI to process alongside of it to do double checks, but it allows us to be able to, for example, accelerate weather prediction and make it better. It could change the insurance industry, if you will. It can massively change drug discovery because it has the ability to be able to break down and do massive calculations that would have taken teams of hundreds of scientists hundreds of years to work on, and a quantum computer can take those in. And so there's a lot of things going on in here. So I'm going to have you flip the page, and then I'm going to leave with just a couple of things because I have a flip the page, please. Because I think the other thing worth watching in here is the one thing we saw from a trade standpoint is it's really important. China's realistically the only country that was able to push back against the US and push back against Japan and a lot of other things going on. This geopolitical pivot and the US focusing on the Western Hemisphere, there's a lot where China is trying to find its footing, if you will, in the global markets as well. And it's pushing hard on the fact that, I mean, for right now, they've got a chokehold on rare earths, and they're using it against Japan. They used it against the US. It puts them in a different footing, if you will. And so keeping an eye on the Southeast and what plays there, when you looked at, it got buried in the weekend because the US was busy with Venezuela, but China, Japan, and Taiwan, and all of what was going on there, especially China practicing a chokehold on Taiwan, that has implications as well, because as we all know, the vast majority of semiconductors for right now come out of Taiwan, and there's a lot of important trade that goes through that. And so flip the page, please. Hopefully this comes through. These are graphics that I pulled from a place called the Visual Capitalist. And the primary thing you have to look on the left-hand side is 25 years of trade differences between the US and the EU, not substantially much change. On the right-hand side, the red is China, and where China has trade dominance, and that's pretty dramatic flow of difference. And in the U.S. too, relative to the U.S., where the U.S. lost a lot of trade dominance in South America. So those are the kinds of things that the market at its peril, especially the stock market, is very short-term oriented and focused on a lot of things there. So flip the page, please. And these covers actually do a good job of, you've got West Coast, East Coast sort of, or Western Hemisphere, Eastern Hemisphere sort of focus, and trying to figure out where markets go. So flip the page, please. And I'm going to actually, there's charts in here that won't show up. So if you do request the deck, and if it doesn't come through in this deck, you can email me and I'll make sure it gets out there in the right format, because there's some charts in here that show that the bulk of the time, no matter what time period you're looking at, something like 75 to 80 or 85% of the time, based on a 6-month, 1 year, 3 year, 5 year, 10 year, returns on markets tend to be positive. Because the bottom line is despite recent uncertainty, analysts said today they will continue to make predictions. It's really hard to predict markets in the short run, and because by their nature they're random. But the other thing is in that randomness, there's this underlying trend that tends to be, as I say pretty simplistically, up and to the right, and it's based on economic fundamentals. And there's so many moving parts in the world there. I didn't have a chance to talk about the dollar, the Fed or bond markets, but the critical things, which I need to go back and put this in terms of what investors should be watching. One of the other critical things they need to be watching is the 10-year yield, not just in the US, but around the globe. In my simplistic way of thinking about it is that short-term rates are controlled by central banks. Long-term, if an investor is going to buy a long-term bond, they have to believe in the viability and the reliability of getting paid back. And most bond investors are telling you they have less trust in the intermediate and longer term levels. They have less trust in politicians than they have in CEOs and companies, because CEOs and companies have shareholders, they have boards that they have to attest to if they're publicly held. Well, not just publicly held, but they have boards they have to attest to. And so you're seeing that in the bond market, and the bond markets have been the best governor, if you will, on politicians in the short run who are coming out of whack. So there's a bunch of questions. Can someone... Oh yeah, we haven't discussed earlier. There's way too much to talk about, and I apologize because I desperately wanted to leave 10 or 15 minutes for questions, but maybe let me run through some of the questions. I addressed the .ai.com. Good. No, we haven't discussed oil, and oil is definitely interesting, especially as it relates to where it's coming. The most confounding thing of all is when, quite honestly, is when President Trump pulled the energy execs into his office and said, we want you to invest big time in Venezuela for the good of your country. And Exxon is like, hey, wait a minute, we need some assurances before we invest there. And now President Trump is trying to cut Exxon out of anything, which, because the last thing those energy executives realistically need is a whole bunch more oil on the system. So I'm going to tie it off there. I did not leave anywhere near the amount of Q&A that I wanted to. Actually, if you get the deck, the chart that I left on page 36. Can you flip to see if you can flip to page 36? Sorry. It goes through there, that one. I was going to pause because that's the way I feel about markets on a day-to-day basis. But it's really important to pull through and keep focusing on that longer term trend and trying to find the positive in this, because, Global Chamber, you're dealing with businesses trying to deal elsewhere. And I know the policies coming out of the Trump administration have been very shocking, and they've on a lot of different fronts and turn pivots. But the overarching, especially looking at this year, is that there's talk of another one big beautiful bill. Tariffs are here to stay. They're higher than they were at the beginning of the year, nowhere near as high as the beginning of 25, nowhere near as high as they were on Liberation Day. And we'll see if the Supreme Court lets the macro ones stand, but they're still impacting individual industries. And so coming back to these companies and their ability to dodge and weave, I'm in awe at watching them over and over and over again. And it's not just the big companies, it's the small ones too, figuring out how do they make hay, if you will, out of all of this. And so I'm going to leave it there. and apologize for running over and for not having the detail in these charts that should have showed up.
Do you have a couple more minutes, Carol?
Sure, I do.
Okay, so we are going to run a little bit over then. What I'd like to do, maybe Mila, if you could remove the share and so that we can see Carol, and there we go. And so I'd like to go to a couple people first and then open up the floor for questions. Kevin Brown, who is such an extraordinary resource for BMO in Chicago. What are some of your reactions? This is maybe your first time to see this entire deck together. Do you have any reaction to what you're seeing here today?
So great question. And I had a little bit of a sneak preview to Carol's presentation, which I appreciate, but it is still pretty fresh information for me as well. I think as I think about, the companies that we work with in the commercial banking side, if I look back on 25, some of the topics that Carol touched on, certainly AI is front and center on a lot of people's minds. The tariff situation, interest rates, geopolitical events, right? So I think all those things kind of played a factor in 25. And if we look at kind of a microcosm of just kind of what's transpired, like in the last maybe 1 to 2 weeks, right? It's almost, Carol and I had an exchange before the event, and she felt like there was like a full year's worth of activity here just in the last week or two. So I would kind of echo that. I think, I would say our clients and prospects that we work with, generally speaking, vast majority of our clients had very good years in 25, and I think everybody's optimistic about 26. I think that being said, right, there's been a lot of events that have transpired here in the last week or two. That's all still pretty fresh for everyone. So I think we're still kind of gauging reaction, with some of our clients on that front. I think as I look forward to 26, like I said, I think tariffs, interest rates. Obviously, we have some pending changes forthcoming here with FOMC and how that's going to kind of impact, short-term interest rates. So I think that's certainly on companies' minds. I think some of the things we've seen with our client base is, a lot of companies still, really flush with liquidity kind of coming out of the pandemic. And a lot of companies have maybe right-sized their operations and their P&Ls and their balance sheets. So we've seen a lot of companies, certainly with borrowing needs, but also with treasury and depository needs. And how do they kind of maximize, the return on their excess cash? So I think that's a trend that we've seen. I think the other thing that we've seen, again, partly due to the tariff situation and just, as Carol kind of touched on, right, with, things like steel and lumber, right, and all those materials that go into product, with those things rising. I think certainly, I would say probably the second half of last year, we've seen companies maybe dip into their lines of credit just a little bit more because of those things, right? Commodity prices are increasing. There's maybe a little bit of a pass-through effect relative to the tariffs. So we've seen companies maybe dip into their lines of credit a little bit more. So jumping around a little bit, Doug, but to your question, those are, some of the things I think that we've seen with companies that we work with, either as clients or prospects. But again, I would have to say, much like Carol mentioned, in terms of the outlook for the financial markets in general, kind of where the tire hits the road for our clients, I would say generally, everyone realizes that there's, geopolitical events and things that are changing in real time. But I think all that being said, I would say the vast majority of companies that we work with are, optimistic here about the coming year.
Great recap. Thank you, Kevin. Demetris Evans is the board chair for Global Chamber Chicago. Demetris, you had a couple questions and some comments and some emojis as well. Thank you for your leadership. Any reaction or any comment?
Yeah, thank you so much, Doug, and thank you, Kevin and Carol. I am so pleased. On behalf of Global Chamber Chicago, I just want to say thank you. When we were thinking about what do we do for the beginning of the year, and we said we need an economic outlook. And I mean, what I imagine is exactly what you presented. So thank you so much to go back and look at what has already happened and the way all markets, I feel like you covered big companies, small companies, I mean, I feel like nothing was left out. And I know like
Well,
you were
thanks.
saying something about your presentation, like some things weren't showing up, but the information was so fantastic. I don't know if we noticed. Okay. It
Good,
was
good,
really
good, good.
I want to say something. I'm totally following the Supreme Court. I'm like, on pins and needles about what they're going to do about the tariffs
Oh
because
my.
will get their money back or some money's back. And I think that that's great for smaller companies. Also, you brought up AI, and how if it's taking over, we may not be so interested in having employment surge, which is a total paradigm shift for me. But I have been following the universal income
Yeah,
conversation
yeah.
to see how that factors in there. And then, thank you for mentioning oil because I have so many clients that are like on pins and needles again about what's going to happen with oil. But you just put my mind to rest. Like maybe we don't even need so much oil right now. So just again, thank you so much. It was
Yeah.
perfect.
Well, thank you. And the interesting thing about oil is like a lot of the depression that you've seen or the pullback in price you had is because people were fearing about global growth. But if global growth comes in stronger, because think about it too, you've got the EU said it's stepping up spending. Japan just issued last week the biggest defense budget that they've had since before World War II because they've taken the break off, like Germany's taken the break off because they're like, look, if the US is pulling back and saying we're not going to be part of these global entities anymore, we're going to do this, we're going to spend big here. And Germany and the EU taking their debt break off and saying we're going to spend on infrastructure as well for part of that spending. There's an argument to be made that we do need more oil. We're past peak oil, if you will, that there's some support out there. The big energy companies don't necessarily want to drill a whole bunch more now and drive the price down because there's capacity out there. But all of these shuffles of things, it's like I was trying to use the analogy in some of our internal talking points last week that it's a lot like the analogy for me is when the auto companies are going to roll out a new model, they take the plant down for a while to retool. And I feel like that's where we're going in the economy. And the cool part about small companies is the thing I'm trying to get my head wrapped around the small companies, because those stocks have definitely participated. And you've even seen it in the first week. By the end of last week, the Mag 7 were down year to date 0.5%. And the Russell 2000, which measures small cap, was up 6%. So you're seeing that broadening out and you're seeing it move down the capitalization curve. But the small companies, on the one hand, they have the ability to be able to hire, to the extent they want engineers, they have the ability to hire them because they're getting laid off from the tech companies, so they can hire better and easier than they could have a couple of years ago. And on the other hand, small companies too can leapfrog use of AI and things like that because they have access to cheaper versions, if you will, of AI, and they don't have to like run it through the constraints. I worked at Wells Fargo for close to 30 years, and the constraints of being affiliated with the big bank and all the hoops you have to jump through to get new technology are very different than they are in a very small company when you're like, oh yeah, that's cool, let's have it on the desk by the end of the day. And so there's a lot, and it's like parsing through all of those factors it's what makes it really interesting. It's one of the things. The other thing is when I talked about, because I touched on this, and we actually I'll repost it on my LinkedIn later today, but we just issued this morning our capital market assumptions for the next 10 years. And we build out these three big themes in that piece. And the markets, I think there's different shock absorbers, if you will, on markets now that allow people to be able to, okay, I'm going to hold my core stocks and bonds here and maybe some cash position here. But then if I want to participate in this potential thing, I can go buy it over here or take a bet on it over here in the prediction markets, or I can buy a leveraged ETF so I don't have to disturb that core. And I think it allows investors to be able to ride through the potential headline shocks that come. And so that's where it's been really unique because I've written through my whole career, I've written a lot of internal triage, like commentary about, I spit some out yesterday morning to my strategy partners about if we need to put something out based on the Fed thing, here would be my start on it. What does everybody else want to say? And I've written monthly and quarterly, but I'd never written a weekly piece until a year ago. And so trying to figure out, like, today's the day that I write this week's piece that goes out on Friday, and figuring out as I'm thinking through what I want to write about for Friday, what has applicability, what matters beyond Friday of the 99.5% of things that we're getting in here that, you know, the media hyperventilates about, but have zero applicability to companies or businesses. And so that's been a really interesting process, but it's also been useful because there's an awful lot on politics and social issues that doesn't necessarily matter short term for markets that's been going on this year. So more to come. And I have a feeling like that's where I said buckle up again, because we started last year's with buckle up. And I definitely think we're going to see volatility in here. But I think those evolution of markets has made it. Yes, oh, Canada, global and unstoppable. The funny part is I get a lot of memes on my Instagram. I've trained my Instagram to make me laugh because so I get like really insane memes in there. And there was a great one in there last night about a guy from Canada saying we're just going to annex Minnesota, and he was listing off all the reasons why Minnesota is just like Canada anyway. And I laughed so hard when I did it. And then there was someone from Wisconsin that said, hey, we have all those things too. We'll bring the beer and cheese. Can we be part of Canada too?
Yeah, hold my beer, literally. Exactly.
Yeah, exactly. Hold my beer.
Very cool. Well, I think we probably need to wrap up. Before we do, I'd like to just recognize a few people. We have some chapter leaders, Vinayak Gupta, who has been our board chair for San Francisco, and he's an energy expert. And I know, Vinayak, you wanted to get into this meeting, and if anybody does have energy interests, Vinayak is the guy. And so if you'd like to say something, of course, please go ahead. Rob Lance is also in this meeting. He's a chapter leader for Global Chamber in Denver. He's also very well connected, not just to the Denver community and DCFR, the Denver Council for Foreign Relations, but also the German community. And Rob, thank you for being such an amazing leader in Denver. And I'd also like to recognize Laura Raguto of FIT, the Forum for International Trade Training, is a long time, like maybe not that long, but at least a couple years, partner with Global Chamber. And I think there was a meeting this morning earlier, Laura, with you and Global Chamber talking about 2026. And you'll be a speaker at our Toronto event, along with Carol and along with Tomoko King, who's in the audience. We're doing a conversation about Canada and Toronto at Trowbridge on the 29th. That's in person. I'll be there in Toronto, my second time to Canada in a couple months. That was also going to be via Zoom. Vinayak, did you have anything to say about energy?
No, thank you, Doug. And Carol and Kevin, what a presentation. Thank you so much. Thank you so much. And I'm so glad that I was able to participate in this. As I think everything you said is absolutely spot on. Perspective, looking at global energy, like both, a combination of oil and clean energy, it seems like where we are headed and like tariffs are unstoppable, is what I would say. But when you look at the world of data centers, and I'm pretty sure you're doing some very deep research in that area, but data centers are coming fast and furious. There is an energy crisis like we have in the US, just like I would say last year or the year before last, 2% of the entire US energy was given to data centers or was consumed by data centers. And the expectation here is by the time we reach 2028 or 2029, there would be like about 4 to 6% of total US energy consumption would be within data centers. So one of the things that I'm seeing is battery industry is really growing fast and furious, not just within China, but outside of China. And I think the US infrastructure is gearing for that. Not only just Tesla, but many other, I'd say, South Korean companies are making headways in the US in terms of manufacturing. I feel the manufacturing sector, like to the point that you made earlier on, manufacturing sector in the US is growing fast and furious, especially in terms of like battery manufacturing, semiconductor manufacturing. So it's like there are some choke points, which what I see from the point of view of like TSMC is one of the biggest choke point, or probably the biggest choke point. It's NVIDIA's number one choke point from that perspective. If you look at it from that point of view. And then NVIDIA is the biggest choke point for all the Max 7, NVIDIA included, of course, in that regards. So there are things that I think we would need to watch. And I wanted to hear if you have a perspective or have you looked at in some way, shape, or form in those choke points, given we are out of time. So if you have 30 seconds, you may want to give some perspective. But energy-wise, if folks on the call or anybody wants to do a deeper dive in that regards, I'd be very happy to connect and I'd be very happy to give my perspective. But really,
That's all.
2026, I'm
That'd be
looking forward to the year.
that'd be a lot to cover in 30 seconds. But did you have a reaction, Carol? Oh, Carol, are you there? Or you're on mute? Sorry. Oh, did we might have
Let me
lost.
unmute.
Oh,
Yeah,
there we go.
see, actually, I was looking. Yeah, I was looking for the. I had a clip in one of our morning meeting notes from one of our technology analysts that was talking about TSMC is actually building active production capacity in the United States, and most of what they sell in the United States should be manufactured there within the next couple of years because they've got something like 6 plants under construction, and there was an announcement. I was trying to find it, so that's why I'm looking off to the side because I've got another screen over here where I clip different things topically, and there was something just in the last day or two. And the interesting thing is there too about because my long-term thinking, part of the justification for President Trump going in and doing what they did with Maduro and under the drug auspices, if you will, but it's really about oil. And we need our assets back that they took from us. I'm like, let me tell you, if Taiwan or China or whatever goes to war, the first thing we're going to do is nationalize those TSMC plants that are in the Southwest. It's the first thing that'll happen.
Completely. No, thank you. Thank you for that. A lot to cover, a lot to talk about, but I'll leave it at that for now.
Most of that
fantastic.
TSMC investment is happening in Phoenix,
Yes.
That's right. Yep.
It's coming up on the 5th annual Global Chamber Semiconductor Summit in Phoenix at Thunderbird is on February 18th, and I encourage all of you to register, be in person at Thunderbird where our headquarters is, or you can attend via Zoom. Last year, we had the honor to interview Stan Shi, who is the founder and CEO of Acer, and the number one business leader, global icon within Taiwan, and also on the board of TSMC. And so we'll have an equally fun and interesting and dynamic conversation this year because of so many things going on. I saw a prediction that it's going to be a very short time between now and when China invades Taiwan. Until now, quite honestly, I think most of the belief was that was years away, and so we'll just have to see. But that interesting.
But China's got it in its plan that it wants to be ready to do it by 2027.
Yeah, that historically it's been longer term, and I saw something this last week that said it's now accelerated. I don't believe that. I just don't think China is prepared for that. But I'm not an expert. You're the expert. That's why you're here, Carol.
I don't know. It just like it's sort of like, to me, it's like things with Trump, because all along people are like, well, surely he can't, and he does, and it's just like, so every time someone says surely he can't, I'm like, yeah, tell me why not? Because
Rob, we see your wonderful face, and so thank you for joining us today. Is there anything that struck you or anything you'd like to add to the conversation today?
I just want to thank you. I feel much better equipped to handle some clients because I
Good.
represent, as Doug knows, I represent a lot of Germans, Austrians, Swiss, and other folks. In fact, we've got a contingent here from Germany, and they come to the United States for energy reasons and other reasons. And the great thing about our governor, our mayor, is we seem to be a flyover for a lot of people that don't want to deal with the U.S. because we've been fairly friendly, and seeing some of the possibility, some of the threats, and some of the obligations we're going to need to take care of next year is enlightening, mainly because my answer to most of my clients is when they ask, what do you expect this year? My answer is usually, I really have no idea. and it has a lot of dynamics to it. So thank you.
Yeah, absolutely. And actually, the piece I wrote last week, I actually took all those issues. I started laying out the things markets were going to focus on, and I ended up being able to do A to Z. There's like 26 different things in there that I wrote last week. And then our look back and look ahead were the last two issues of December as well. So and we always make sure that the theme is 2 pages thereabout. So it's a nice quick read if you want to go out there, or
I'll have to reach out. Yeah, get that, because I mean, your point earlier is anytime our president says he's going to do something, and then you think, oh, he's not going to do that. He does, or he does something even stranger.
Yeah,
it's very unsettling for the Europeans. And I mean, I'm not making any kind of statement politically here, but what I'm just saying is our clients are very uncertain about working with the U.S. and kind of having more ammunition, the better.
And I think that's it's one of the reasons why we really leaned into the geopolitical or the global pivot piece of it, is because when you look at Canada in particular too, because they're like, okay, we're going to stabilize the relationship we have with the U.S., but we're going to parallel work hard with other countries. We're going to work hard interprovincially, and then work hard with other countries as well to help stabilize and improve those relationships. And you look at, it's really interesting. I mean, the biggest challenge with the EU countries is that they've got the EU and they've got a macroeconomic, but from a security standpoint, they've got 27 individual countries that have to step up. And so figuring that piece, but they've also got a very aggressive Russia on the East Coast, and they've got a lot of need to step up. And I have a lot of these conversations with my son, he's in the defense business. He was a Marine and is in the defense business. And I asked him at the start of all of this, early back in January, about, a lot of the European defense, because I'm like, look, if you're Europe and the US says, great, you're on your own, you're not going to buy your military equipment from the US, you're going to buy it from European manufacturers. And so that goes into that global demand as well, and the changing nature of relationships.
Thanks, everybody. I think it was very aggressive of us to try to think that we could do this in 60 minutes. And so it's obviously went a little bit over. I wonder, Kevin and Carol, if you could each make some closing comments, and then we'll wrap up.
Well, just thanks for the opportunity, and thanks for letting me dry run my presentation. There's some pages I need to slice out of there and do some things, but there is definitely a lot to cover this year. And please reach out if I can be helpful on anything or provide any more information, because a lot of this different stuff I've written on at one point or another in the last year.
Really, thank you for the information.
Yep.
Kevin, anything else you'd like to share?
Yeah, thanks, Doug. Really, I would just echo Carol's comments. Again, thanks for the opportunity today. I think Carol and I would both say, right, one of the favorite parts about our respective jobs is being able to meet with and provide valuable information to clients, prospects, other business leaders, in the business community, folks that are, on the call today, et cetera. So again, if you have any questions, or just like Robert had, please reach out to us either via LinkedIn, or we'll work to get you some email addresses, and we'd be happy to again be an information resource and answer any questions that we can after the event here today.
We just have been through almost 90 minutes of a great presentation. Thank you, Carol and Kevin. BMO is a tremendous resource for businesses across North America. And so thank you for being part of Global Chamber. Over an hour ago, we finished up a wrap up of our UK chapters and a great summary of what's going on there and some of the perspectives and great market opportunities. We have tomorrow a conversation for Australia, the US, and France that we're doing. It's about 26 hours from now. And so, one of the things that I'm left with is not only is there amazing opportunity, but the changes and the speed of change is happening at historic paces. And so, it's important that all of us stick together, communicate. And one of the, I think, greatest testimonials I've heard about Global Chamber is from Bill Edwards, who I'm fortunate to be able to have lunch with, along with the Global Chamber Los Angeles chapter tomorrow at the Japanese Village Plaza in downtown Los Angeles. He's got 50 years of trade experience, and he said, Global Chamber is the best networking organization in the world. And separately, he said, the reason why is that I can get on a call and I can talk to people on the ground and get what's really happening. You know, all of us are inundated with the media and stuff that's happening, and who knows what's really true. And there's economic indicators that are happening. But at the end of the day, if you can talk to somebody like Kevin Brown, who's on the ground in Chicago, you're going to get the real skinny. And you heard the real skinny today from Carol in Minnesota as well, and Demetris. And these are people that know what's going on. They sort through all of the activity and tell you what information you need to grow your business. So thank you all for being part of this conversation. Thank you all for being part, or many of you, most of you, for being part of Global Chamber, and we'll catch you next time. Thanks, everybody.
Thank you.
Thank you.
Thanks, Doug. Thanks, everyone.
Thank you.
Thank you all.
Thank you. Bye-bye.
Hey, thank you, Mila, as well, for the slides and everything else, for making sure that this all worked out well. It went a little bit longer than expected.